Are you ready to head down the path to an abundant retirement? We're tackling the topics of the mind of the modern retiree here on Navigating an Abundant Retirement Radio. And now your host, Carol Dewey.
There's actually an interesting silver lining behind this painful tariff chaos. Liberation Day was an absolute mess. The new tariffs that President Trump announced were far more aggressive than anyone had expected. A 10% minimum universal tariff and country-specific tariffs north of 50%. It was a full-scale shock to the global trading system. Investors have been panicking ever since, selling hand over fist in an attempt to mitigate risk. As a result, the Dow Jones slid over 3%, the Nasdaq Composite took a 4% plus nosedive, and the S&P 500 sank more than 4% as well. Now on track for its worst week since the 2020's COVID crash. Not to mention, China declared that it would impose additional 34% tariffs on the U.S. to match those that Trump announced last week. This move is stoking fears that our nation's trading partners will retaliate instead of negotiate, exacerbating the ongoing trade war. And yet, buried underneath all the chaos, there actually is a silver lining forming, one that could reshape the economy in a very big and very bullish way. The 10-year U.S. Treasury yields collapse. It's not just a footnote in this story. It might actually be the main event. Let's start with the numbers. Tariff fears are pushing the 10-year lower. Earlier this year, the 10-year Treasury yield was pushing 4.8%, a level that was putting real pressure on the economy. That's because the 10-year largely influences mortgage rates, business borrowing, consumer lending, and a whole lot more. But since the trade war rhetoric escalated in March, and especially after the Liberation Day announcement, that yield has collapsed. Indeed, just before Trump's tariff announcement, the 10-year was hovering around 4.25%. By that evening, it had dropped to 4.07%, and as of last Friday, we were sitting at about 3.93%. That's an 80-plus basis point drop from recent highs. In bond market terms, that's not a gentle breeze, that's a hurricane-force tailwind for the economy. And I'd venture to say that this is no accident. It's policy by design. That is, in recent weeks, both President Trump and Treasury Secretary Scott Bessent have made it clear that their economic focus isn't on the stock market. It's on the bond market, and specifically the 10-year yield. As Bessent said in a recent interview, we're watching the 10-year, not the Dow. Translation? This administration's goal isn't to juice the S&P 500 with feel-good headlines. Seemingly, it's to strategically depress long-term interest rates, which influences everything from mortgages to auto loans to small business credit lines. There are going to be long-term gains. From what we can tell, the Trump administration is trying to stimulate Main Street, and they're using bond markets psychology to do it, with a particular focus on the 10-year yield. That makes sense because it's hard to overstate how influential the 10-year is for our financial ecosystem. It's the anchor rate for an entire constellation of borrowing avenues: mortgages, corporate bonds, auto and student loans, municipal bonds, personal and small business loans. When the 10-year drops, everything else drops with it. And with yields down more than 80 basis points in the past couple of months, we're already starting to see borrowing costs decline across the board. For example, mortgage rates are dipping back toward 6.5% after threatening 8% just a few months ago. That's huge. Lower borrowing costs means that more buyers can afford more houses, businesses can refinance at lower costs, consumers have more flexibility with credit, municipalities can invest in infrastructure more affordably. In short, lower rates mean more activity. More activity means more jobs, more spending, and eventually more growth. Tariffs are the no risk, no reward. Now, is this a risky strategy? Absolutely. You don't slam global trade partners with 50% tariffs and expect everything to go smoothly. You don't deliberately trigger a market panic and hope it resolves itself peacefully in a few weeks. But as any seasoned investor knows, where there's no risk, there's no reward. This administration is playing chess, not checkers, meaning these tariffs are the opening move, not the end game. The real apparent goal is to force the world to the table, restore trade balance, and reignite economic growth at home, all while keeping inflation in check through lower long-term yields. If this plan works, it could represent a masterstroke of economic engineering, short-term pain in exchange for long-term gain. So far, it's working. Yes, stocks are down, brutally so, in fact. But the real economy is still hanging in there. Unemployment remains near historic lows at 4.1%. Consumer spending continues to hold. Retail sales are positive year over year. They were 3.36% as of just February. Business investment hasn't collapsed. And now, with the 10-year yield breaking down, all those macro pillars could get a second win. Lower rates mean more affordability, more financing, and more risk-taking. This is the exact stimulus through rates strategy the White House was gunning for, and it seems to be taking root. Right now, investors are fixated on the tariff headlines, and understandably so. But in the process, they're ignoring what might be the most important macro development of 2025 so far: a sustained collapse in long-term interest rates deliberately engineered by policymakers with the express goal of re-stimulating economic activity. So what's the final word? If the trade chaos is resolved in the next few weeks as we expect, lower rates will remain in place, but the uncertainty premium will evaporate. And when that happens, stocks will likely explode higher, powered by the twin forces of re-accelerating growth and cheap capital. This is the same playbook that ignited the 2019 to 2012 and the 2020-21 rallies. Of course, we're not naive. We know the risks are real. A full-scale trade war would be a recessionary blow, but our base case hasn't changed. These tariffs are negotiation tools, not permanent policy. The next 2 weeks will likely bring deals, not doom, and as those deals come together, the downside risk gets repriced rapidly. Meanwhile, the 10-year has already done its job. Its decline has triggered lower rates and planted the seeds for the next economic upswing. Markets just haven't caught on yet. That's your opportunity. The ongoing market unpredictably can be scary. But since that turbulence drives stocks both ways, you can't really afford to be crippled by fear and sitting on the sidelines. You do need to be in the game. This isn't the time to sit back and wait for clarity. The markets are rewriting the playbook in real time, and the smartest investors are already adapting. Bonds are breaking down, volatility is up, and yet under the surface, opportunity is taking shape. If your portfolio still relies on outdated strategies, it's time to pivot. Fixed indexed annuities can offer a powerful alternative to bonds, protecting your principal and positioning you for growth in this new rate environment. And if you're worried about your market exposure or feeling paralyzed by uncertainty, there's a strategy for that too, one designed for turbulent markets just like this. Bottom line, now's the time to review, realign, and re-strategize. Waiting it out is not a plan. Take the next step while the window's still open. Let's talk strategy. Give us a call to schedule your complimentary lifestyle and legacy assessment today.